Welcome back. This is Citizen Business Center. Now, over the last 3 weeks, the government's cost of borrowing has seen a dramatic drop as reflected by the fall in the Treasury bill rates by a cumulative 6% points. This development has also seen the cost of borrowing between banks decline from high of nearly 30% in September to the current rate of 10% to 2%. And the question that now begs is how soon will this translate into lower lending rates for the retail borrowers? We did a spot check of what various commercial banks are currently charging on personal loans, and here are the numbers. Something to note, though, is that most banks are optimistic that the rates might start declining by January 2016 if T-bill rates decline and remain stable. Now, if you have a loan with Equity Bank, personal loan rates are currently they're standing at 23 to 24%. Previously, between September and October, they are 20 to 21%, and June and September, they are going to 18 to 20%. Now, that means that non-check-off loans are going at 25%. Previously, they were going at 20%. That is if you're taking a loan. You've taken a loan with Equity Bank. If you've taken a loan with KCB, personal loan rates are check-off loans at now in November. They're 22 to 25%. Previously, between September and October, they were 18 to 22%, and in June and September, they were about 18%. That is for KCB. And moving on, if you have a loan with Cooperative Bank, your personal loan, the check-off loans stands at 23% currently. Between September and October, they were 18%, and June and September, they were also at 18%. Non-check-off loans currently stand at 25%, and previously they were at 20%. That is for Cooperative Bank. If you have a loan with Barclays Bank, and all personal loans are going between 23.90%, that is standing now in November. Currently September, October, they're at 22.50%, and in June and September, they were at 16 to 19%. If you have a loan with Standard Chartered, check-off loans are going at 21.50% currently. Previously, between September and October, they were at 17%. Non-check-off loans are going at 22.50 to 25.59%, and previously they were at 18%. If you have a loan with Family Bank, currently you'll be paying your loan at 22%. Between September and October, and June and September, you're paying at 18%. Non-check-off loans are standing at 24% currently, and previously they were at 20%. Well, I've said something to note, though, is that most banks are optimistic that the rates might start declining by January 2016 if T-bill rates decline and remain stable. Over now to Terian.
Thank you very much, Michael, for those numbers. Of course, that spot check there showing that interest rates over the past 6 weeks have risen by at least 4%, 5% and 7%, depending on who you are banking with. And we're ready to have that discussion with Habil Olaka, the CEO of the Kenya Bankers Association. Mr. Olaka, thank you so much for joining us on the Citizen Business Center. Quite some increase there, between 4 to 7%, yet Central Bank Treasury has been very vocal in recent days, saying Treasury bill rates have been coming down. And the expectation has been that this would almost immediately reflect on personal loans, for instance.
Yeah, I think the discussion, I mean, you're right in the sense that the Treasury bill rates have significantly come down over the last auction. Actually, there was a marked decrease in the Treasury bill rate. But I think we need to sort of like discuss how the interest rates are determined, because the Treasury bill rate is not the only determinant. It's a significant determinant because it drives the cost of funds in the market. And banks depend on picking the deposits from the market to be able to lend to the customer. So the cost at which they pick the deposits determine the rate at which they lend to the customer. Now, what has therefore happened is that as the T-bill rate comes down, it will, of course, obviously translate into a lowering of the lending rate in the market. But as it was mentioned, it needs to be some sustained decrease rather than just a slight decrease and then we go back to a high rate. So hopefully, given the trend that has been observed over the last 3 or so auctions, where the rate is coming down and the trend continues, then we expect the same to be translated into lower lending rates going forward.
Is it unrealistic then for Kenyans to expect the banks to reduce the interest rates as fast as they hike them?
I think the interest rate regime is governed by a framework that has been put in place. Banks have got to, for example, when the rates are going up, they've got an obligation to give a notice to the customer. You give the notice of 30 days before you actually effect the interest increase or decrease, whichever way it's going. Now, the numbers that were being shown on the screen reflect, for example, a movement from October being effected in November. So the increase that was significant, the 4 to 5% increase, is actually taking effect from around now because the notice was given about 30 days earlier. So same thing will happen. When the rates start coming down, again, banks will give the required 30 days notice of the fact that the rate is moving whichever way, and therefore before you effect the decrease.
One would argue that the framework is in favor of the banks because then they have 30 days to warn the customer or to tell the customer that the rates will go up, yet when it comes to bringing that rate down, one would say we'll wait for the central bank to sit with the Monetary Policy Committee, or we'll wait until January when the KBRR will be set. So does that framework favor the banks more than it does the consumer?
Actually, one of the points you're raising is in terms of the fact that when the framework of the KBRR was put in place, it was put in place at a time when there was quite some stability. And we had assumed that we will try this framework in a stable environment. And it was working quite well until we got into this turbulence. And therefore, there are quite some bit of learning lessons for us as well in terms of refining the framework to be able to support the industry in any interest rate regime. So those are things that there's already a team that is working between central bank and the KBA to try to address some of those challenges. But be that as it may, I think the framework has worked well. And going forward, I think it will be able to support the industry in trying to control the rates too.
Are we saying, just clarify this for me, are we saying then that the Kenya Bank's referencing rate did not work as it was supposed to work, as the plan was?
It worked well, but at the time when there was a turbulence,
it is not working
because of the fact that, you see, the framework is such that it's meant to be revised every 6 months.
Yes.
Now, if there's turbulence in between, before the 6 months are over, it will be a long time for the market to wait for the 6 months, especially if the volatility in the market is quite significant, as we noticed recently. And therefore, the market has got to respond to the volatility in the market. And if the framework is not allowing them to respond, there's always that pressure. That's something we have learned, and therefore we have got to put mechanisms in place to ensure that in the event that there's volatility, it has got to be adjusted sooner rather than waiting for the 6 months. So
would I be correct to say that probably the revision of the KBRR will now happen in less than 6 months?
Ideally, what would happen is that if there is turbulence, if there's volatility in the market and there's significant volatility, then it should be revised sooner than the 6 months.
All right.
However, in the periods of stability, if there is relative stability in the market, then you also want to give that stability in the pricing regime, and therefore you want to revise it every so long rather than revising it too often. Yeah.
We've been getting mixed statements from, you know, as varied as the people that we ask about when they expect the interest rates to come down. Recently, the Deputy President said 2 weeks. We've had the chairman of the Kenya Bankers Association saying also in a few weeks they expect the rates to come down. Treasury expects the rates to come down as well. But some of the people that we're speaking with who are serious analysts in the industry say the soonest the interest rates can come down is January. Is that a fair analysis?
I'm not quite sure on what basis the analysis are talking about January. I think the interest rates are a response to the market movement, and as I mentioned earlier, if the factors that contribute to the rates in the market come down, there is no reason why the market should wait until January for the response to be achieved. So as soon as we start seeing the response in the market, ideally, then we should also start seeing a response on the credit market as well from the banking sector.
We expect the Central Bank Monetary Policy Committee to sit any time, perhaps next week. Any indication of how you see that meeting going?
Well, without trying to second guess, because normally there's a rationale behind the decision that they arrive at. They'll have looked at the macroeconomic indicators and on the basis of that arrive at a decision. But however, already in the market you can see a trend. One of the factors, for example, inflation, in terms of anchoring inflation expectations, I think that has been to an extent kept within the the target. In terms of the foreign exchange, foreign currency, the volatility in that market, I think again we have seen the exchange rate, for example, moving in the right direction, and so we are in fairly good state. Now, with the various indicators coming, my guess is that it looks unlikely that, or rather the probability of the CBR, for example, going up is much lower than the probability of it remaining either constant, where it has been, or possibly coming down.
All right. We've got a caller on the line. Good evening. Please tell us who you are, where you're calling from, and your question. I think we seem to have lost him there, so I'll just get into my next question. If Central Bank, for instance, reduces the CBR rate next week, how soon should banks reflect that signal to bring the interest rates down?
I think there are two things. The CBR would change, and consequently it should actually change the KBRR, because KBRR is based on two factors: the T-bill rate and the CBR. So when the CBR moves down and the T-bill has already come down, consequently the KBRR should come down. Now, once it comes down, all the loans that are priced on the KBRR would come down consequently by the same margin that the KBRR could have come in. So banks then have got the 30 days notice to give a notice to the customer, and consequently the rest should come down by the same margin. So that's an automatic thing, and that's why the KBRR was put there.
Tell me, are banks willing to extend the tenure of the loan, just for the ease of the customers who have taken loans and are paying what has been comfortable for them, but suddenly they have to pay such large amounts of money? Is there a way banks can extend the period for their customers to pay their loans for a longer time?
Actually, it's not that is there a way. Banks are actually doing it. We saw it in 2011, 2012, when we had the same kind of challenges where the rates went up. Banks employed the same kind of approach, where in order to cushion the customers who had budgeted for a given amount of installment, you can accommodate them because of the interest rate increase by extending the repayment period, or alternatively capping the increase by a given percentage, and the additional you can extend the repayment period consequently. So there are a number of modalities that the banks can, in agreement with the customer, reach a comfortable repayment period for the customer to be able to go through this temporary volatility in the interest rate regime.
Now, Central Bank has just released a report that shows banking activity over the last few months, and I'm just wondering, in the light of the interest rate spikes over the last 6 weeks, would you have an idea of how the uptake of loans has been?
I think from the report that you mentioned, the credit report that Central Bank has released relating to the third quarter of 2015, clearly, and the comparison is with the third quarter of the previous year, I think the uptake in terms of credit has, to an extent, been fairly flat, except that some sectors actually have picked up, which shows that there is still credit expansion. There's still, especially for the productive sectors, there is still appetite for credit. It's only mainly the consumer loans, for example, where the uptake has been reduced, partly because of the impact of the interest rate in the market, and that's a normal thing. It is expected to occur.
All right, we've got a caller on the line. Please tell us your name and where you're calling us from. Please go ahead.
You're from Mogotio.
All right, please go ahead.
Yes, to answer that, okay, I do have a question to our guest today, and I have two questions. One is that most of the time, we find that clients in the bank sector do deposit money for interest, and they do bargain, for good interest, like maybe 12%, 13%, 14%, depending on the amount of money that has been deposited. Okay. Can this happen that when, like now in the market, you find that the index has gone so high? Is it possible that now, again, using the same calculation, the banks also do do offer this to their clients? For instance, by issuing them, as I guess I've said, maybe a duration of time in order that maybe the interest that you deposited maybe is going to yield more. Okay. My second question is this. My second question is that, according to me, I feel like it's not appropriate. It's not appropriate actually for a borrower who has borrowed the money in the bank, and then maybe the interest rate was 20%, and then maybe we're going to maybe the interest rate is hiked to 30%. I don't think this should be in order. Okay, my question on that what is this?
All right. Okay.
Is there a way that maybe it can be elongated or prolonged? If somebody is supposed to pay for maybe 5 years, it should be elongated maybe for 10 years.
Okay.
10 years. Yeah.
Thank you, Moses from Ogochu. I believe we have answered your second question already in just before we picked up the call from you. His first question, do you have a response?
The first question is about the deposit rates, and what happens in the market is that when the rates move up, you can actually walk into the bank and negotiate your deposit. It's a matter of negotiating with your bank. Mm-hmm. I think the bank is unlikely to call you to come and pick a higher deposit rate. It's a natural thing, but you can actually, because you've got the power, you can go into the bank and negotiate a better rate, mm-hmm, depending on the movement in the market. And that's what's happening. Customers who are market savvy walk into the bank and demand a higher rate, and the bank will give you because they need the deposit.
All right.
Yeah.
Okay. I'm told we need to wind up there, unfortunately. Thank you so much, Habil Olaka, the CEO of the Kenya Bankers Association, giving us insights into when we can expect lending rates to come down, as well as an explanation of exactly what it takes for banks to set their interest rates. Thank you so much for joining us on the Business Center tonight.
Thank you.